Capital accumulation is a structural science. It bypasses linear labor, relying instead on ownership, leverage, and optimized systems. The first prime directive is to build. You create a value-producing machine from zero, standardize its delivery, and scale its distribution. For this to generate wealth, you must retain majority equity. The second directive is to buy. You allocate surplus capital into productive assets that already function. This begins the process of decoupling wealth generation from your physical labor. The third directive is to join and convert. You embed specialized labor into high-leverage systems to extract outsized income, then aggressively convert that income into equity stakes. All three directives operate on a singular principle. They divorce asset valuation from the finite limits of human time. Before deploying any scaling vectors, you must install 10 foundational behaviors. These serve as the prerequisite operational baseline for extreme capital accumulation. First, you track net worth instead of gross income, measuring what you keep rather than what passes through your hands. Second, you suppress lifestyle inflation immediately upon your first income jump. Third, you capitalize your earning engine by purchasing assets that increase your output. Fourth, you prioritize market-agnostic skill leverage over chasing linear corporate promotions. Fifth, you transition from present value salary to future value equity negotiation. Sixth, you position yourself in close proximity to institutional capital flows. Seventh, you deploy asymmetric risk by strictly capping your downside. Eighth, you reject consumption debt in favor of acquisition debt used to obtain growth assets. Ninth, you escalate your environment to raise your expectation baselines. 10th, you reach the threshold where ownership makes more money than you could make actively working. Without this structural baseline, the capital generated through high-velocity growth is often lost to the same behavioral inefficiencies it was meant to exploit. To force revenue generation within a strict 12-month timeframe, you apply the 12-month protocol, a rigid sequence designed to systematize early-stage growth. You start with strict temporal isolation. You synthesize operational theories, select a singular high-yield skill, maintain operational secrecy, and purchase proximity to elite networks. Next, you target demographics with existing capital. You force a proof-of-concept transaction, document your processes for replication, focus on a singular distribution channel, and asymmetrically delegate repetitive tasks. Finally, you productize your service. You maintain minimal personal burn rates, reinvest in output tools, analyze apex competitors, and adjust your supply and demand inputs. This approach treats 0-1 wealth generation as a manufacturing process. While market risk remains, consistent inputs increase the probability of predictable revenue growth. High-velocity capital frequently rewards individuals who exploit behavioral inefficiencies. These operators bypass traditional metrics of intelligence in favor of psychological arbitrage. These individuals operate with delusional conviction. They use pure confidence to bypass gatekeepers, treat rejection as volumetric data, maintain high variance swinging, and replicate proven models without ego. They reduce social friction to access elite rooms. They build autonomous management teams despite a lack of micro-skills. They monopolize attention, prioritize execution velocity over analysis, and accept optimization that is simply good enough. They outperform experts via temporal arbitrage and structural loopholes. They survive through endurance, prioritize emotional resonance in branding, and occasionally benefit from the phenomenon of failing upwards. In instances of failing upwards, massive public collapses are reframed as high-value educational signals, often attracting further capital for subsequent ventures. Extreme venture capital losses are frequently followed by rapid refunding. The market often interprets these failures as scale-tested experience rather than simple loss. Within capital markets, uninhibited execution speed and relentless iteration frequently outperform a more deliberate but slower analytical approach. To breach the 7-figure threshold, we can map 15 wealth vectors across 4 primary quadrants of velocity. The first quadrant covers foundational vectors: traditional index compounding, real estate development, pre-IPO startup equity, franchise scaling, and SMB operational partnerships. The second quadrant details high-variance vectors, including crypto and meme assets, contrarian prediction markets, leveraged derivatives, scalable digital IP, and algorithmic attention monetization. The third quadrant includes operational arbitrage vectors, M&A acquisition targeting, high-commission B2B sales, supply chain flipping, and proximity engineering. The final quadrant maps specific pathways to 7 figures, such as white-label dropshipping, specialized labor, perpetual royalties, and unit economic subscription models. Correctly matching an individual's risk tolerance to the appropriate structural vehicle remains the primary pathway away from linear earning. Scaling from millions to billions requires the adoption of apex architectures, frameworks that allow for the capture of entire market segments. Framework 1 is high-growth founding. This involves building a singular entity to a position of global market dominance. Framework 2 is securing strategic ownership stakes, massive equity acquisitions in existing creative or technical engines that can scale. Framework 3 is technological frontier exploitation. In the industrial era, this meant forming monopolies by capturing the infrastructure of essential resources. By controlling the means of production, the mills, and the transport lines, early industrialists captured the entire value of the supply chain. Dominating transit nodes ensures that every movement within a market contributes to the owner's wealth. This historical pattern of infrastructural capture applies directly to the modern era of computing and software layers. Framework 4 is leveraging cultural capital. This involves transitioning fame into the ownership of hard assets and intellectual property. Athletic branding demonstrates how cultural influence can be converted into a scalable, long-term asset class. Frameworks 5 and 6 involve long-horizon compounding through capital allocation and building diversified portfolios to mitigate the risk of ruin. Decisive. At the apex tier, wealth generation functions by owning the underlying infrastructure of culture, technology, or capital. Generational capital faces 5 primary threats: high personal burn rates, poor partnerships, litigation, taxation, and vanity projects. Apex wealth is institutionalized to create a legal buffer between the assets and the personal decisions of those who benefit from them. This involves the use of trusts and thrift clauses. These move ownership to a legal entity that is insulated from external creditors. Staggered temporal access and incentive distributions ensure that capital is released according to calculated timelines or behavioral milestones. The bifurcation of rights is used to separate corporate voting power from the economic dividends paid to heirs. Finally, prenuptial mandates and formal family constitutions are employed to manage internal conflict and provide a clear framework for decision-making. Generating wealth requires exploiting systemic leverage and velocity. Preserving it requires protecting that system from the variables of human behavior.